Hi everyone, welcome to another honeystocks.com stock market outlook video, which will be going out on the weekend of the 21st of January 2023. Now, what a wild couple of weeks it's been. If you picked up my last analysis a few weeks ago, you've probably done pretty well. That was the performance of the stocks and the ETFs that I discussed. I will link the video if you missed it at the end. But before I switch over to my screen share and walk you through all of the charts and logical data that I like to go through every few weeks, I just want to take the opportunity to thank everybody for all the nice words and nice messages that I've received since the analysis that I last put out. The big question that's on everybody's lips at the moment is, has the market bottomed or is there some pain just around the corner? So this week what I'll do is do a market deep dive, and as always I've got some individual stocks and ETFs that I think warrant being added to your watch lists. Now, for disclosure, some of the charts and some of the ideas that I will be walking through, some of our clients and myself may hold positions in some of the stocks mentioned, but as you all know, I do not use the magical hindsight indicator. I timestamp all of my work, which is incredibly important for the field in which I work. And although I do use technical analysis, the first thing to say is I'm not a short-term day trading guru or anything like that. There's plenty of gurus out there all over YouTube. But for me, I'm primarily a trend follower. I'm looking for big moves in the market, $20, $50, $100, etc. I'm not in there scalping 20-cent moves, which is ridiculous. So I'm going to be looking at the markets, trending areas of the markets, logical turning points in the market. I think you'll probably find a lot of value from my work if you have a similar approach. I'll try to give some context around the broader market today. Some of my recent time-stamped calls to give myself a little bit of credibility. Over the course of the last 12 months, I've not got a lot wrong. I called the market crash at the start of the year, the rotation from growth into value stocks, the bear market rally in June, the exact top in August, the exact top in the US dollar, the bottom of the most recent bear market rally in October, and the exact market top again in December. I've also done and called the bottom in bonds and the bottom in China, and you can go all the way back to 2020 where I got our clients ahead of the crash. My work is highly thought of in the professional field, and I have a track record of being mostly correct, which helps, as I said. So feel free to like, share and subscribe on Twitter, and feel free to like, share and subscribe on YouTube as well. There should be a little red dot subscribe button if you're watching on mobile to subscribe on your screen. So let's get into the charts and let's see what the market's telling us and what we can expect over the next couple of weeks. Now, before I get into the charts, please pause the video. Make sure you are comfortable with that very important disclaimer before watching any further. Basically just says that there is not any investment advice, and don't be silly, please do all your own due diligence. Now, a logical place to start is maybe for you fundamental folks, the macro folks. I get it, the yield curve is inverted. We know that this is very bad. My work is predominantly focused on identifying trends in the market for as long as those trends last. So at the moment we are in the midst of a massive rally in the market. There are rotations everywhere, but I just want to add the caveat that I am very mindful of this data, and I am aware that stocks could have a rug pull at any moment. So now that we've got that out of the way, let's start off with Captain Obvious, which is the S&P 500. Now, if you have followed my work for any more than 5 minutes, you'll know that this is a trend line that I've been on top of since August, which was the catalyst, one of the data points that helped get defensive ahead of this decline. But of course, we're not using the magical hindsight indicator here. We're looking towards January. We're looking at now, and what can we expect? Well, We are, of course, testing this trend line again. The market is coiling up like a spring at the moment, and the big question is, do we break out or do we break lower? Well, the S&P 500 isn't actually the main chart for me at the moment. What I am communicating to our clients and our members, and what we have done over the last few weeks, is actually to use the US dollar as the gauge for market direction. Now, the reason for that is it's been the story, dollar up, stocks down, and of course over the last few months a dollar has been going down and stocks have been going up. So there's not any real surprises for me. We can look at the longer term chart for the US dollar index and we can see that it is breaking below key levels. Now, for me, this gives us a bit of a clue as to what comes next. If the US dollar is going to continue to decline, that would be in an environment where you would naturally expect the S&P 500 to break out and move higher. Now, the big problem for me over the last few months has been that the S&P 500 hasn't been an accurate representation of what's actually been going on with the market. Now, again, if you followed my work for any more than 5 minutes, you'll know that I've been on top of the gold moves, the copper miners, the boring industrial, the material names, etc. And one of the charts that I've been using has been the NYSE composite index, which is a much better gauge of the broader market. Now, we are again pushing against this big 16,000 level, and if this breaks out higher, now as I record this analysis, we are coming towards the end of the session on Friday. The market has been on a rocket ship today. So I haven't checked the data to see where this ultimately has closed, but this 16,000 level, as we can demonstrate, is quite significant. So if we are going to break out in the S&P 500, again, I would want to see the NYSE composite breakout here. It's very, very important. We've got the correlation between volatility and the US dollar index, and we can see that if the US dollar index is going down, that's an environment where the VIX is also going down, and if the VIX is going down, we can reasonably assume that the S&P 500 is going up. Now, that's just logic. There's not any fancy data points with it. It's just absolute logic to me. We can also look at the high yield versus US Treasuries. We are continuing to make higher lows. Of course, where this chart goes, the S&P 500 tends to follow. So I'm looking at data points like this just to give me little clues as to what comes next. Ultimately, what I'm looking for are the trends and the structural trends within the market to remain intact on an individual stock basis. You know, bonds, commodities. These are all just data points, but they all, for me, come secondary to the individual trends for the stocks and the areas of the market that you own or want to own. Now, since I made a bottom call on bonds a couple of months ago, of course, the bond market has been moving higher. It's been a bit of a base. It looks like we're basing again. But ultimately, the trend for me is currently higher. Of course, if the bond market is going up, again, it's quite reasonable to assume that the stocks will follow. We've got TLT, again, had a massive rip. But again, we're pushing up against key technical levels in the market. Basic support and resistance really just helps with risk management at this exact moment in time. Our message to our clients and our members last week actually was with the S&P 500 pushing against these levels. You know, there's nothing wrong with, you know, taking some profits off the table on stocks that you're essentially trading, but of course the longer term investments for, you know, stocks like Apple, Microsoft, etc., those are stocks that you dollar cost average on. But, you know, for the areas of the market that you're maybe trading, we need to be very, very mindful of these levels. We already know that the Dow has been the place to be this year. I think we're currently 7% away from all-time highs. We've got the Russell 2000 again pushing against big levels in the market again. Had a big decline this week, but of course there's been a bit of a rally on Friday here. But ultimately, I think for small caps to get a lot more interesting, I think we probably need to break out this range that we're currently in at the moment. And of course, if you've been following my work in my free weekly letters, you'll know that I've been expecting a massive rotation back into technology over the last couple of weeks. Ultimately, that's probably what we've seen. I think price has been telling us that. But the big question is, is the market going to break out or is it going to collapse around the corner? I am looking at charts like the 10-year Treasury note yield as well. Again, it looked like this week that we would potentially get a breakdown, but just to state Captain Obvious here that support and resistance isn't a thin line. It's usually an area, and ultimately it looks like this area is currently holding up at the moment. So that's quite important for technology stocks because we know that there's an inverse correlation between the 10-year note and technology. Of course, if the 10-year note is going down, that's an environment where you would expect XLK and the mega cap tech names to start to move higher. But, like I said, it's no real surprise. Over the last week or two, the 10-year note has been going down, and of course technology has caught a bit of a bid. But it's going to be very, very interesting to see next week what actually happens. We know that earnings are going to be a massive driver for what comes next with the market, and unfortunately I don't have a magical crystal ball to state what exactly will be reported. The value versus growth debate, I have highlighted this a number of times now that coming out of the dot-com bubble we had a massive rotation into value, which was a multi-year rotation, and ultimately we've pulled back and we're starting to see this play out a little bit. But we will, of course, always see these shorter term rotations into growth, etc. They can all go up together. But I think if you are someone that values outperformance, then value for me will probably, although I should say as well, I do reserve the right to change my thesis on a moment's notice. But I think at the moment I am still looking at things through the lens of value. Over the longer term is more likely to outperform growth, but we will see. Now that of course leads me into individual stocks. Now, as I'm sure you can imagine, after my work that I put out a couple of weeks ago, I've had many of you asking for updates on existing charts, which I will do my best to cover. But I think it makes sense to look at big tech to kick things off. As you all know, if you picked up the analysis a couple of weeks ago, you'll know that I made reversal calls on both Amazon and Google. Now, both of those this week have met upside objectives. Congratulations, some big numbers there. For these to be interesting, I would very much like to see these break out above these next levels. I think if they start to break out, if you have Amazon and Google reporting positive earnings, etc., then these are going to get very, very interesting very, very quickly. We've got Apple threatening to put in a bit of a failed move. We've got Nvidia again. I made a bottom call on this one a few weeks ago, and it looks like there's a bit of a chart pattern starting to play out. Now, I'm not one of those big chart pattern guys, to be perfectly honest with everybody. I just view it as a big rounding base, and ultimately I want to see these levels break out. I think that 195 level is probably going to be quite big for Nvidia. But again, if you are in there and you are holding Nvidia, congratulations again. It does look like it's potentially setting up, but again, we're going to have to wait and see how the S&P 500 reacts to all of the corporate earnings. Now, for disclosure, Tesla has been a big recommendation of ours over the last couple of weeks to our clients and members. Massively, deeply oversold chart. Ultimately, we've made a bottom call on it. Will it be the bottom? Who knows? The message was bullish above $100. We're up at 133 at the moment. We are still in a bearish RSI regime, which basically means that we want to see RSI get above 50. I think if RSI can now get above 50 here, then again Tesla could well start to get very, very interesting very, very quickly from a bullish perspective. Now, update on YPF. If you follow me on Twitter, you'll know that I've been screaming this one from the rooftops for a couple of months now. We did get a massive pullback this week. I highlighted to our clients and members the likelihood of a pullback with RSI being up at 85 was likely. Now that's ultimately what happened, but the trend is still very, very much intact. I've been covering this one since $7. We're up at obviously 12 now, and again, we've got low PE ratios, we've got solid 12 months earnings growth, and the fundamentals are there. But again, I understand it's probably a name that many of you won't have heard of, but it is a $4.5 billion market cap company. Again, Crocs, covered this one a couple of weeks ago. Originally covered the breakout, and it's just been motoring higher. The trailing stop now is up at 115. We've got Micron Technology. Again, made a bottom call on this one, but there is still another 13% upside in my opinion. Again, reasonable PE ratios. That's something that I'm quite big on at the moment and have been over the last 12 months. We've got BHP Group, steel company. Ultimately, massive upside potential. We've been covering this one for our clients since its breakout. $175 billion market cap, low PE ratio, again, solid 12 months earnings growth. Verizon has had a big pullback over the last week. Originally covered this breakout a couple of weeks ago. It has pulled back to a logical level. Now, is it a valid retest, or is it about to collapse below the breakout levels? Again, reasonable PE ratios. Obviously, the earnings growth isn't really there, but it is still a massive company, and I think Verizon might make a lot of sense to many of you that are watching. Now, I'll quickly just touch on commodities, because I did cover commodities a couple of weeks ago, highlighting a failed breakdown in the Bloomberg Commodity Index. Well, if we are looking at failed breakdowns, again, it leads us to ETFs in the space. The commodity index, DBC ETF, has been an absolute rock star. We have an upside objective there around 26. Silver miners have been massive. Now they are starting to approach big levels for us. I think if we can get a breakout above this $32 level, that is going to be massive for many of the silver miners. We've got gold, again, is still motoring higher. We've got a 195 target on gold. If gold is moving higher, of course, that leads us to things like the gold miners, junior gold miners, massive relative outperformance versus the S&P 500 over the last couple of months. Some individual names that you might want to consider. Barrick Gold has been massive. We've been covering this one for our clients and members for a few weeks now. We've got Wheaton Precious Metals. I actually posted this chart to Twitter a couple of months ago. It's been absolutely massive. This has been a high conviction idea for our clients and members over the course of the last month, and again, we are starting to push against these key levels, the 200-day simple moving average. What I will be communicating to our clients this weekend is if this breaks out above the 200-day, then that might be an opportunity to perhaps add some position to existing wins. We've got the copper miners, and copper, again, we're breaking out above big levels. The copper ETF still, for me, has a lot more upside, although I think a pullback in the short term it can be expected given that RSI is quite high. As most of you know, I did make a bottom call on the 7th of November on the copper miners, and again, they've been absolutely ripping higher. Southern Copper Corporation actually met our upside objective a couple of weeks ago, but it has still kept moving and moving and moving, and it's been absolutely massive. Congratulations anybody that bought it. And of course we've got Freeport McMoran, which, as you would expect, with SCCO moving higher, Freeport McMoran has been doing exactly the same, and it has been consolidating above another breakout level. But what I like about these types of charts at the moment is if you utilize these types of tools, which it's not any accident that price tends to kind of rebound from these levels. I do have very specific parameters set for this, but what I like about these charts is it's a very, very risk to reward proposition. So you're not really giving up much, but there's obviously blue skies ahead, which I like stocks that are making new 6-month highs. Now, some ETF updates, of course. Peak negativity with the ARK Innovation ETF and with consumer discretionary. For me, they've put in failed moves. I covered these a couple of weeks ago. The ARK ETF is up 15-16%. The consumer discretionary has been killing it as well. So ultimately it's really just a case of just applying some kind of trailing stop and seeing how far they go if you are into ETFs. KWeb, again, one of the charts called a bottom in China on the 24th of October. The problem I have, I think, with China at the moment is it's probably starting to get a little bit overcrowded. This is maybe the problem with jumping on at the end of a trend. If you are buying into positions when they've already moved 100% in a couple of months, especially, with ETFs, it's very unusual for ETFs to move 100%. So I'd be very, very careful jumping on to China. Ultimately, it can continue to move higher, but I think the ETFs probably make a lot more sense than the individual stocks at the moment. One of the charts that we've been covering for our clients over the last few months has actually been Baidu. I might bring that up in a second actually, because it does look quite interesting. We've got a potential failed breakdown there in the clean energy space. Again, I think if you're above $40 there, I think PBW makes some sense. And again, just to reiterate the bottom call that I made on cloud computing, the Sky ETF, there is still some ways to go there. I think maybe another 8 or 9% upside, and ultimately we'll see what happens when it gets to those levels. But if you just let me bring up Baidu here, there we go. So the chart for Baidu probably makes complete sense to everybody. Failed breakdown, massive upside. We've been covering this one for a couple of months now, and that's a massive number to be working with, but we'll see ultimately how far it wants to go. Now, what I would say is if you are still here, it probably tells me that you're getting a lot of value from my work, so it would mean the world to me if you were to hit the like button. Let me know in the comments as well what you think comes next with the market. Do we go higher? Do we collapse? What's around the corner for the markets? But if you have just recently stumbled across my work for the very first time, please do go and check out our website at honeystocks.com. We provide our premium work to our clients and members, both professional and retail investors, but we provide access to our premium weekend work, which we put out every weekend to our clients and members. We provide high conviction investment trade ideas. Now, I'll happily show you what that looks like in just a second. We provide access to our midweek halftime, which goes out every Wednesday. We provide access to a wonderful community of investors and traders from all over the world. And We also provide access to all of our chart books. And if you are somebody that is in the process of learning more about the markets or technical analysis, completely free with all of our memberships, we provide access to our complete technical analysis program. But just to show you what our high conviction ideas look like, this is a recent idea that went out for Meta, which is still open and doing great things at the moment. That's an idea for Meta. That's the idea that went out for Tesla with instructions above $100, but again, makes a lot of sense. Netflix is another massive winner, but it's not all technology stocks, as you know. We are looking at things like gold companies. I touched on Newmont recently. ExxonMobil has been massive. Elf Beauty, who knew that budget makeup brands could move in such a way that they did. That was just recently stopped out. But it's feel free to check out our website. But just to go back and show you, we timestamp all of our work, so feel free to go and check that out. All of our high conviction ideas that we've ever sent our clients and members is all logged on our website for complete transparency. You can see the stocks that we recommend, the date that we've recommended them, the price that we've recommended them, and how those stocks have gone on to perform. And you can also click on the link for all of our big time-stamped market calls. Again, very, very important that work is time-stamped in my field. So feel free to go and check out all of the big market calls that we've made over the years. It's all logged, it's all documented, and again, I think this should be the industry default. But if you have stuck around here to the bitter end, again, thank you very much. Please do hit the like button, and hopefully we can welcome you to our community. Thanks very much for watching. Thanks.